Most people think they understand the 2008 financial crisis. They remember the headlines about subprime mortgages and giant banks failing, but the story you were told is incomplete, missing a critical day when the entire system nearly froze. This was the moment the world came within hours of a total, irreversible economic collapse. It happened not in 2008, but during a panicked 24-hour period in 2007. This single day revealed a vulnerability in the global economy that few knew existed. Today, we are going behind the scenes to uncover the secret history of the day. The housing market nearly took down everything. The crisis was triggered by something called the shadow banking system. This system operated outside the traditional scrutiny of regulators and had ballooned in the 2000s. It involved investment banks, hedge funds, and money market funds trading exotic, complex debt. This debt was primarily based on mortgage-backed securities bundles of home loans. Wall Street had devised a way to take risky loans and stamp them with AAA ratings. They called these products collateralized debt obligations, or These CDOs were complex financial time bombs, and they were everywhere. The core of the problem was the immense scale of leverage involved. Banks were borrowing billions to buy these CDOs, multiplying their risk exponentially. If the underlying mortgages started failing, the whole tower of debt would crumble instantly. The first signs of trouble appeared not in America, but If you are fascinated by how hidden financial forces shape our history, like this video and subscribe now. We are committed to revealing the truth behind the biggest economic events. In the summer of 2007, two German banks were struggling under the weight of bad U.S. mortgages. This was a warning shot the American markets largely ignored. But the first true crack appeared in France with a bank called BNP. In August 2007, BNP Paribas announced it was freezing redemptions on 3 investment funds. Their official reason: they couldn't calculate the value of the American subprime assets they held. This technical announcement was the financial equivalent of shouting fire in a crowded theater. The immediate fear was, if a major global bank cannot price its assets, who can? This instantly destroyed trust in the entire shadow banking system. The instruments holding the market together began to fail. These instruments were short-term loans called asset-backed commercial paper, or ABCP. ABCP is how banks and corporations borrow money for a few days or weeks to handle payroll and inventory. It is the lifeblood of daily economic activity. Overnight, the market for ABCP simply vanished. Lenders refused to lend money because they couldn't trust the collateral they might receive. This is the day the financial plumbing seized up, August 9, 2007. The entire global financial system relies on banks lending to each other constantly. When that lending stops, the economic engine starves of cash. In the United States, trillions of dollars needed to be rolled over that night, and the market was dead. If the banks couldn't get that short-term funding, they would default. This wasn't just about Wall Street. It was about every business that relied on these short-term loans. Suddenly, companies couldn't get the money to pay their bills, buy supplies, or run their operations. The real economy was seconds away from a massive, synchronized shutdown. The Treasury Department and the Federal Reserve realized the gravity of the crisis instantly. The collapse of ABCP meant the failure of the interbank lending market. The solution was unprecedented intervention that nobody saw coming. The European Central Bank, or ECB, was the first to act. Within hours of the BNP Paribas announcement, the ECB pumped 94.8 billion euros into the market. It was the largest single liquidity injection in the ECB's history at that time. The Federal Reserve soon followed suit, injecting billions of dollars into the U.S. banking system. This was not a bailout. It was an emergency defibrillator for the heart of global finance. They were forcing cash into the system to restart the seized lending mechanism. What the public didn't know was how close the system was to total failure before the injection. Had they waited another 24 hours, the damage might have been irreparable. The problem was that the injections solved the immediate liquidity issue, not the core solvency issue. They provided the aspirin, but the patient still had cancer. The banks were still loaded with toxic CDOs based on failing mortgages. But the immediate panic was averted, and the market limped along for another year. This moment was the silent prologue to the great financial crisis of 2008. It was the first clear signal that the housing crash was not just a housing problem, but a systemic one. What they didn't tell you was that the solution created a dangerous precedent. It showed banks that in a systemic crisis, central governments would always step in. This created a massive moral hazard, encouraging even riskier behavior later. The central banks learned that they had to intervene decisively to prevent collapse, but they also learned that their tools were not designed to handle the shadow banking system. The regulatory framework had failed to keep pace with financial innovation. The aftermath of that day led to the eventual collapse of Bear Stearns and Lehman Brothers. The crisis that started with frozen French funds ended with the world facing a second Great Depression. The critical lesson from that August day is that trust is the only true currency in finance. When trust in the value of an asset vanishes, all lending stops instantly. And when lending stops, the entire global economy stops with it. The housing market collapse was not a slow fade. It was a sudden, violent, near-death event. We often focus on the dramatic collapses, but the most important day was the one where the system simply choked. The swift action of the central banks that day is what saved your 401k and your paycheck. This hidden history proves that the difference between crisis and catastrophe is measured in hours. It took the world another year to process what that single day revealed. The true heroes and villains of the crisis are often found in the most obscure corners of finance. This is the power of understanding the financial plumbing that connects us all. The events of August 9, 2007 remain one of the most important lessons in modern economic history. We must understand the shadow banking system if we are to prevent the next inevitable collapse. Share this video to ensure this crucial piece of history is not forgotten. Help us educate the public on the systemic risks that still lurk in the financial world. We will continue to expose the hidden narratives that shape our economic future. Thank you for watching this deep dive into the day the world almost broke. Stay vigilant.